One of the primary functions of an auditor as well as a fraud examiner is to look for preventive measure, to install preventive measure that will prevent fraud from happening, or if it has ever occurred, revisiting it after the fraud has been identified and putting in place the right intervention mechanism that will prevent the reoccurrence of such fraud. So, like we identified, or like we talked and discussed in the previous class, the different intervention mechanism that we call wall of intervention that disallow fraud from metamorphosizing from pre-fraud era of pre-fraud stage to post-fraud. If you can recall, we said internal control, corporate governance, regulations, and prevention techniques. But let us consider something. There are some kinds of fraud that defies intervention mechanisms a lot. It will take rigid intervention mechanisms. This kind of this kind of frauds, in most cases, they do what? They defy internal control measures, especially. What are these? One of them that defies, I'm taking internal control measures, especially out of the wall of intervention mechanism now. Internal control. Collusion easily defies internal control. Collusion is a secret agreement for a legal purpose, that is to collude. When 2-3 people, only a single person can collude. So when we are talking about collusion, we are talking about minimum of 2 persons. It could be 2, it could be more. So we said one of the basic attributes or characteristics of a good internal control measure is separation of power and duties. By the time 2 people from different desks or different departments now collude, maybe you are the one that is meant to sign on this thing or sign off these things before it leaves the organization. You now collude with the person that is meant to initiate it. The initiator, the initiating leg colludes with the approval leg. You can see that the internal control will find it difficult to identify such fraud or to prevent such fraud. The internal control will be weakened where there is expansive syndication of collusion, where a lot of people from different departments that they have duty aligned, they have reason to communicate in their line of duty. The separation of duties that has been put in place by the internal control measure will be rendered useless where there is collusion. Illegal cooperation between 2 or more employees to get access to each other's part of the system. That is, you want to get access. Now, I want you to approve this thing for me. I'm the initiator. So I want your own part that I want to access is the approval, because I know if you don't approve it, I can't get away with it. If you question it, I can't get away with it. So when there is a syndication of this, then there is problem for internal control. That is, you've been able to leverage on the synergy of your fraudulent propensities to assess the organization's internal control. The second of such is override. Management override. Management sometimes override internal control to have their way, especially in institutions where corporate governance is weak. Management can just override. We are talking about corporate fraud in this instance in most cases. Maybe the management wants this and they want it. They want the accounting department to make false entries. They just override. Like, no, this is not what we are doing. We veto this. Go and put this in. We are not paying this much tax. Go and work around it. Minimize it. In fact, we want it cut by 80%. We don't care what you're going to do. They've overridden the integrity of that financial statement. It happens a lot. And in most cases, unless if you have internal control or the staff in charge of the system that want to be overridden has strong personal integrity, We mentioned that under the fraud scale. So the person can now escalate it. Maybe sometimes even it leads to media and what. But these are very rare cases. The popular thing is, okay, management has said this. The instruction of the management instantly becomes a law. So sometimes they override their own policies when they want to get their way. Then a clique of management executives for their own personal interest can override a particular internal control measure or wall of intervention and get away with what they want. For instance, in a situation where the internal control is at the mercy, the internal control officers and executives, they are at the mercy of the management executives. So they don't want to lose their job. When they see things going wrong, they can't talk. Even the other employees, maybe the senior accountant, the finance officer and all that, they have their job to protect as well at the end of the day. So when management speaks, it is difficult to go against what, even when it contravenes the conscience of the person involved. We are talking about job. Maybe they are paying them well. They are able to afford vacations. They are able to afford sending their children to the best schools. Their wives goes on shopping sprees. We are talking about their legal salary now. And management wants to override something that is fraudulent. You will consider, despite your integrity, sometimes it might cause you to consider the most important, is it your means of livelihood or your personal integrity? So these types of fraud or categories of fraud easily defies intervention mechanism. So as a fraud examiner as well, when you are examining fraud, or even as an auditor, you should be able to filter collusion. Look out for possible collusion. For instance now, if a particular approval desk, I'm just using for instance, kept approving initiation of transactions, maybe for procurement of company assets, coming from a particular staff, and you see it frequent and they are of high sum, you begin to query what is happening. So for an auditor or a fraud examiner, it could be that you will assess other means, other tools, like their emails, like their files, you see the connection between these two people. You'll be able, something will point you to the fact that there has been collusion. And that's why the trend of transaction keeps going like that. When you see, for instance, now, a transaction keeps going to a particular contractor or vendor of the company every time, and they are huge sum, and their own under 2 days, maybe their payment cycle for their vendor takes like 2 weeks. You see, the day the vendor supplies and the day it collects his money, it takes 2 weeks, it takes 3 weeks. But for a particular vendor, you see that there is a recurrent payment of under his own cycle is just 24 hours. All the approval legs has gone through. Then there is a collusion somewhere. Maybe nobody is even supplying anything at the end of the day and they quickly want to get their money. So it moves fast like a jet in the approval system. Maybe 3-4 people are meant to approve, and you are seeing that under 24 hours, something that takes, you know how public sector especially works, that can take 2 weeks on one desk before it goes to the other. Under 24 hours, the person has already cashed out. You begin to see that these trends are not normal. One power that an auditor or a fraud examiner especially has is ability to sense anomaly. When you have the ability to quickly sense anomaly, something that breaks from the norm, something that breaks from the culture, then you are halfway into detecting fraud or sensing the symptoms of fraud. So what are we saying? When it comes to collusion, when it comes to override, you need extra caution and extra sensitivity, as will be seen how you can actually detect fraud in the coming class.